Have you ever wondered what happens when Wall Street meets AI, crypto, stablecoins, tokenized stocks, and decentralized supercomputers all in the same room? It's not a futuristic concept. It's the reality of cryptocurrency in 2026. And the implications are far-reaching for anyone who's considering their next move in the crypto world. But before we dive into how cryptocurrency is changing in 2026, let's look at where it stands today. Trust me, by the end of this video, you'll have a crystal clear understanding of what every investor should know for the future of money. The core financial pillars, shaping crypto in 2026. First, let's talk about the core financial pillars that crypto has to master in 2026. These aren't just theories, they are the driving forces pushing the entire ecosystem forward. Stablecoins, the digital dollar of the internet. One of the most significant developments in the crypto world is stablecoins. These digital currencies, pegged to assets like the US dollar, are no longer just the playground of traders. In fact, stablecoins are becoming foundational to global finance, enabling faster, cheaper, and more secure transactions. It's no wonder that institutions are now using stablecoins for cross-border settlements and everyday transactions. As regulatory clarity improves, stablecoins are cementing their place as the future digital dollar of the internet. These stable digital assets offer the necessary stability that crypto assets like Bitcoin simply can't provide. And they're being integrated into the traditional financial systems more every day. Stablecoins like USDC and USDT are becoming an indispensable tool for institutional investors and have massive implications for financial inclusion globally. Now, if you're wondering why this matters for AI and crypto, think about it. AI agents can't hold cash, but they can hold stablecoins. And because stablecoins are programmable, they can be used to execute automated financial tasks, making them the perfect tool for AI-driven finance. Whether it's making micropayments or conducting sophisticated trades, stablecoins offer AI agents the frictionless payment mechanism they need to thrive. Imagine an AI that executes automated trades across different crypto assets, adjusting your portfolio without human intervention. That's the reality we're moving towards. And it's happening right now. Tokenization, the future of asset ownership. Another major development in 2026 is tokenization, the process of turning real-world assets into digital tokens. This trend is not only transforming traditional assets like stocks, real estate, and commodities, but it's also changing how we think about ownership. Tokenization offers fractional ownership, which means you can buy a piece of an asset that was previously out of your financial reach. This is opening up investment opportunities in real estate, fine art, and even rare collectibles for the average investor. But it's not just about accessibility. Tokenization enables 24/7 trading of these assets on blockchain platforms, removing the traditional market hour constraints. Tokenized stocks and commodities are now trading on-chain, allowing for instantaneous settlement and lower transaction fees. This is disrupting traditional markets in a big way, and investors who are not paying attention could miss out on the biggest shift in asset ownership in decades. AI and decentralized compute, the brains and brawn of crypto. As we move into 2026, AI is becoming more integrated into the crypto world than ever before. No longer confined to just finance, AI is being used to analyze data, automate trading strategies, and even manage portfolios. In fact, AI is now being employed to manage project treasuries, oversee decentralized autonomous organizations, DAOs, and assist in tokenized real-world asset management. With the ability to process vast amounts of market data and execute trades with pinpoint accuracy, AI is helping to create a more efficient and profitable crypto market. And AI isn't limited to just making decisions based on historical data. It's increasingly using real-time data to optimize portfolios and create personalized investment strategies. If you're wondering what that looks like, it's basically an AI-driven portfolio manager that can make decisions faster and with greater precision than any human could. However, while AI is incredibly powerful, it's not without risks. AI agents, when used in trading, are often susceptible to errors, particularly when it comes to interpreting market signals or detecting market manipulation. AI can be overly confident in its decision-making, even when it's wrong, and this can lead to significant losses. A common pitfall is over-automating trades, which can compound small errors and turn them into major financial setbacks. Furthermore, AI agents are vulnerable to MEV, minor extractable value attacks, where bad actors exploit predictable trading behavior for profit. These are all factors that investors must consider before letting AI manage their crypto portfolios. Decentralized compute, the backbone of AI's future. Despite the powerful potential of AI, traditional AI models rely on centralized cloud computing services, which are expensive and prone to outages. With decentralized compute, AI models can be distributed across multiple nodes in a blockchain network, significantly reducing costs and improving scalability. This is the promise of decentralized physical infrastructure networks, DPINS, where idle GPUs and computational power are aggregated to support AI processes. Decentralized compute isn't just about cost efficiency. It also ensures that the AI ecosystem isn't reliant on a single provider or vulnerable to geopolitical risks, which can threaten centralized cloud infrastructure. This new decentralized model of compute gives blockchain its own version of AI supercomputing. And in 2026, this could provide a huge advantage over traditional centralized systems, making it a key piece of the puzzle for crypto investors. Data privacy and trust in the blockchain era. With AI playing a central role in financial decisions, ensuring the quality and accuracy of the data feeding into these systems becomes crucial to maintaining trust and preventing misinformation. Crypto's decentralized nature allows for better data verification, where every piece of data can be traced back to its source and validated across multiple nodes, reducing the chances of manipulation. Technologies like zero-knowledge proofs, ZKPs, enable sensitive information to remain private while still allowing AI and blockchain systems to verify the authenticity of the data being used. This has massive implications for sectors like healthcare, finance, and personal data management, where safeguarding privacy while maintaining transparency is critical. With increasing concerns over data privacy, especially in light of recent data breaches and scandals involving large centralized entities, crypto and blockchain technologies are offering a solution that ensures secure, private, and verified data sharing. Blockchain technology is already being utilized to provide verifiable audit trails for transactions while keeping sensitive data confidential. And as privacy regulations tighten globally, crypto systems designed around these principles will be at the forefront of compliance and trust in data management. What does this mean for investors in 2026? So what does all this mean for investors in 2026? Well, the truth is that cryptocurrency in 2026 isn't just about price speculation and volatility anymore. It's about infrastructure, the technology that powers the next generation of financial services. Stablecoins, tokenization, decentralized AI compute, and blockchain-powered data privacy are all converging into an ecosystem that is pushing digital finance into the future. And those who understand these developments will be in the best position to profit. The most promising investments in 2026 will be those that support this new financial layer of the internet. Projects focusing on decentralized stablecoin payment rails, tokenization platforms, and AI-driven infrastructure are likely to see the most upside in the medium to long term. But it's important to keep in mind that, like all emerging technologies, there are risks. Increased regulatory scrutiny, market volatility, and AI's potential for error mean that this is still a highly speculative space. The biggest winners in 2026, Bitcoin, Ethereum, and beyond. If you're wondering which crypto assets are most likely to benefit from these developments, it starts with Bitcoin. Bitcoin remains a solid anchor for any portfolio due to its store of value narrative and institutional adoption. Ethereum, with its smart contracts and decentralized finance ecosystem, is at the heart of the blockchain revolution and will continue to be a critical part of the financial infrastructure. But it's not just Bitcoin and Ethereum. Stablecoins are now integral to institutional capital flow. AI-driven crypto tokens like Fetch.ai and Render are emerging as the new stars. And infrastructure tokens like Chainlink are powering data connectivity across blockchain applications. In 2026, cryptocurrency has evolved from a speculative asset to a foundational part of a decentralized, AI-powered financial system. Stablecoins, tokenization, and AI-driven portfolios are reshaping finance. However, risks like over-reliance on AI and regulatory challenges remain. Crypto is maturing, and understanding its infrastructure is key to navigating the future of digital finance. So, what do you think? Are you bullish on cryptocurrency in 2026? Drop your thoughts in the comments below. Like, subscribe, and stay tuned for more insights into the future of digital finance.